Here to discuss what this could mean for both the public and private markets is Erik Hirsch. He's co-CEO of Hamilton Lane, one of the largest private market investment firms globally. Erik, welcome. So this geopolitics-driven confidence hit, how does it affect some of the sectors you like, infrastructure, private credit, manufacturing?
Well, John, nice to be back. I think it's a to be determined. I think we had to see whether this becomes a real shooting war. Obviously, what happened over the last 48 hours is incredibly tragic and very scary. But I think the question really is what's next and whether that begins a real spillover. So I think that's what you're seeing the markets react to. And I think now we're all just waiting to see whether there's another shoe to drop.
OK, so focusing in a bit, maybe on the IPO market, we got Rubrik coming up. To me, it's unique, both because of the size of it, because it's a highly anticipated, high-growth cyber name. How does its performance, if it does, differ from some of the other kind of tiptoe into the water IPO entrants we've had?
Well, I think you're exactly right. The public markets are trying to just figure out where the investors are. There's a tremendous amount of capital still sitting on the sideline. And as you know, the public markets just aren't really growing, not in terms of market cap, but in terms of just the number of investable companies out there. And so I think there's desire from the public market investors to have more choice. And so good names, strong performance that are actually cash flow positive, I think are going to resonate. But again, the markets have been erratic and things that are happening geopolitically are not helping that.
Okay. Is there more resiliency when you start to talk about some of these macro dynamics and uncertainties, this wall of worry that is building in the public markets? Are the private markets a little more buffered from that, if you will?
The private markets are just less emotional. So I think it's more of a long-term focus, long-term orientation, and not having to sort of deal with what's happening from day to day to day. And as you noted earlier, we're beginning to see a lot of capital moving out of the public markets because of that. Again, investors are looking for more choice. They're looking for more stability. They're looking for an environment where they can be thinking long term, not sort of day to day or month to month.
In the private markets, there does seem to be some chatter, though, that if you have a Fed that's higher for longer, or as I'm starting to hear increasingly, slower to lower, that perhaps the longer that plays out, that could actually spell some trouble for certain asset classes within the private markets and private credit, commercial real estate, et cetera. How real is that risk here as Fed funds futures pushes out the possibility of rate cuts?
Yeah, Morgan, I think it's actually pretty low risk. I think, one, there's a huge dislocation going on in the lending space. And so the regional banks have largely been disintermediated by what's happening on the private credit space. There in the private credit space, you have a tremendous volume of capital. And so you've got a lot of capital looking for a lot of homes. If rates go down, better for the borrowers. If rates stay flat, fine. And if rates go back up again, which I think is unlikely, the market will also recalibrate. I think the market is recognizing today that we need to sort of recognize that an incredibly low, basically zero rate environment is really the thing of the past. We're not going to sort of come back there tomorrow. And so I think both borrowers and lenders recognize sort of what that new reality is, and they're all adjusting.
Erik, we were talking earlier with Mike Santoli about the consumer, and we know how important consumer spending is to the overall economy. Are there a couple scenarios that you're gaming out about how this ends up for the consumer that's been taking on more and more debt, and at the middle to low end, it's just under a lot of pressure from lingering inflation? What do you think happens next?
Well, I think this is really sort of the sad part of our economy, is that you've got such bifurcation on the wealth spectrum. So as you noted, kind of the low and middle end of the market is being incredibly hurt by inflationary pressure, whether that's gas or groceries. All of that is difficult for them. The high end of the market, which again is a lot of where our spending is actually coming from, and we just saw that report coming out a few days ago, they've been benefiting from a high rate environment. They're not borrowers, so fixed rate on their mortgages, a lot of capital sitting either in the public markets or sitting in cash, all of that benefiting from a higher rate environment. They're seeing their real estate values go up. They're seeing their stock portfolios go up. And so their willingness to spend is actually increasing, and the data really bears that out. So I think what we're seeing is a real bifurcation in the consumer. Small and low end of the market hurt under enormous pressure. That's a problem. But the high end of the market, which represents more total capital going to work, is actually doing quite well.